If you look at the malls or shopping centers, if you go back to the IPOs of companies like Kite or Simon, you'll see that more than half of their original IPO tenants are bankrupt today. So tenants constantly come and go. What doesn't change is the focus of that mall or that retail center at driving traffic. And what you're seeing today are centers like Roosevelt Field, King of Prussia, Southdale in Minneapolis, where they're centers that are the nexus of their retail community, and retailers go there. When you have a mall where they're concerned that a Macy's or a Sears is going to close, that mall's got much bigger issues. If you look at any of the big centers, and at Sandler O'Neill, we cover Simon, we cover Macerich, we cover Taubman. These are the top mall landlords in the country. They're eager to get back a department store box because those boxes are not driving traffic. When you look at tenants today, the stuff they can't get from Amazon are things like theater, restaurants. And even if you look at like an Apple or Tesla, some of the most innovative companies, where do they open up? They open up at the mall. That should be very telling of where even high tech goes to sell their product.
So
it's at the mall.
This to me is brilliantly counterintuitive, because you think that when a Saks pulls out of Riverside Square Mall, it is really going to hurt whoever the owner. I'm not sure who that is.
That's Simon.
That's Simon.
It's Simon.
It's really going to hurt them because they're going to lose that big tenant. And indeed, they did go for a couple of years, but now they've got big theaters in there. Who is navigating that transition from the loss of those anchor tenants to a new reimagined mall the best?
Well, just think about it this way. The department store, the name itself means departments. I mean, years ago, it was a pet store, it was a travel agent, it was a restaurant, it was a hair salon. I mean, it was everything. Today, it's really down to three categories, right? Shoes, apparel, and cosmetics. And guess what? All three of those, you can go elsewhere. So when people go and think about a department store, it's still in that same 200,000 square foot box that it was when it had 10 categories or 12 or 20, but now it's only 3. So the department store model has to remedy. At the same time, look at customers. You know, a decade ago, they needed to walk around in yoga pants. Today they do. No one a decade ago paid for a cell phone. Today we all, begrudgingly pay $1,000 for a cell phone. Today you can't go buy a $2, cheeseburger. You have to buy an organic one where you see the cow walk in to behind and come out as your hamburger. So today, people's shopping habits have changed. They're willing to spend money more, and they're definitely doing it at retail centers where those are the center of the community, convenient to the customer base. What's happened is you've had shopping centers where that target customer has moved away, and those centers have suffered. Those are the ones that you see on the front page of newspapers as the dying mall. But when you go, as I say, to like a King of Prussia or go to Phipps Plaza in Atlanta, you'll see jammed parking lots and packed corridors.
So I know that not every mall is the same, and all of these malls are sort of changing their composition as a tenant leaves, as a big box department store leaves, like you're talking about. Maybe they bring in a fitness center, maybe they bring in a restaurant. But the latest data from Reese does show that the rents are down quarter over quarter for the first time since 2011. I know that we lost Bon-Ton. I know that Sears stores are closing. But as you change the composition of the mall and it becomes less like a mall, what happens to rents? I mean, financially, what changes? Are restaurants paying less? Is an Equinox paying less?
It's the law of averages, right? So let's take a company like Simon. They have about 120 or so malls, plus a number of outlets. Their earnings every year, they generate over $1 billion of free cash flow after paying their dividend. So a center like them for Roosevelt Field, which is over $100 million of cash flow earnings out of that asset alone, that more than dwarfs all these malls that are closing. So when you look down a Macy's list or a JCPenney list and see malls that are closing, where those department stores are closing, none of those are the top tier malls.
Right.
Those are all malls that may have a few $1 million of NOI. So they're really insignificant. So what you're seeing is a tremendous concentration to a core group of malls. And there are a lot of malls that are going to be left out. And so when you look at a law of averages, those malls that are being left out drag it down. But when you look at the top malls, those continue to increase rent and increase sales.